Over to you, Stephen.
Thanks, Mark. All right, let's get started here. So everything's changed is a pretty big headline. And from our view, basically the world's entering a period of massive geopolitical, economic, and social and societal shifts. And Russia's attack on Ukraine will remake the world. And we just don't know how it will remake it, because we don't know how it's going to end and how soon it'll end, and how far they go before they get to the end of the war. Do we get into chemical weapons or even nuclear, or do we get to a negotiated peace sooner? So this is a very different environment than we've been in really at any point in time since the start of the great financial crisis. And it's that way for a lot of reasons. One is the pandemic was a common enemy for the world. Now we have a war being raged in Europe for the first time in decades. And this is, again, not us against an invisible enemy, but against other people on Earth. So this is a very different time. So let's, get into it and talk about some of the impacts here and what we think is going to happen. And clearly, we've gone to a period where we had a lot of uncertainty and volatility before, but the first quarter of this year has ramped up volatility in a way that many people were not expecting coming in. But the outcome of what's going on is going to be lower global growth. We're going to see that play out. Part of that's brought about by the higher inflationary pressures. Part of that is brought out by the supply chain disruptions that are going to continue to go on. And part of that is because of the concerns about the environment are going to impact consumer confidence and corporate confidence, and they're going to adjust their spending accordingly. I think another element of what's going on is there's a lot of focus on the central bank policy and how they're raising rates and how aggressive they're going to be raising rates. And will that tip the economy over into a recession? And I think there are parts of the world that are absolutely on a fast course to a recession. And the sanctions on Russia are well on its way to putting Russia into a severe economic crunch for an extended period of time. But Europe will have a hard time avoiding a recession, given the move up in their energy prices and some of the dislocations that are going to come out of this. So in our view, the central banks will talk up rates and let the market do a lot of the work, but ultimately they will not be able to raise rates as high as everyone thinks, in part because they know they don't have the tools really to fight a recession right now. So rather than create a recession, they'll let inflation run a little bit hotter. I think one of the big outcomes from this is that we're going to see a shift in investment patterns and global trading patterns. And that is a big change. And that is where I think from an investment perspective, we're going to have to think very differently about the world. I think another key outcome of the invasion by Russia is that energy security is going to be a bigger issue than the clean energy transition. Not that they won't be side by side, but it won't be the clean energy transition well above shifting off of fossil fuels. It'll be, we have to secure our own needs first, and while we're working towards an energy transition, which changes the dynamics of how that transition is actually going to work. I think supply chain resiliency is going to be a big issue. We've been battling supply chains for some time now, and now you have another layer on of the supply chain challenges. So last year it was the Asia-US route that was the big stumbling block for the global economy. I think you're layering that on now with rising COVID cases and the one COVID policy, zero COVID policy of China. That's creating some new challenges for trade. And then you add to it, now you have a European security issue on energy, and that's going to redisrupt supply chains again. And then we have the food problem that's existing. So what does this mean for globalization? Is it over? Is it going to be different? Our view is that we're going to be looking at more trading blocks and security blocks of like-minded nations, whether it's autocratic governments versus democratic governments or more regionalized. But there are going to be changes there, and that's going to shift capital flows and shift trading activity. And it's going to require securing and stockpiling things that you need. So I think one of the big things as it relates to globalization supply chains was it was all about the lowest cost and doing things cheaper and fastest. And now it's going to be about doing things in the most secure and dependable way. And I think that shift is going to be material, but it will lead to higher costs. As I mentioned, we believe that the combination of these factors now has recession risks on the rise, when for the US in particular, we were coming into this year looking like we're in a pretty good spot to move past the pandemic and start to move towards more normalization. That seems to be set back. So let's take a look at these. So the OECD came out with an initial assessment on the impact of the war on global growth. And what you can see here is, the US going to get hit by about 1%, a little less, about 0.8. Europe is going to take a bigger hit. I think this was based on if everything stayed the same where it was a couple of weeks ago when they did the survey 2 weeks ago, and if it stayed that way for the full year. I don't think that, I think things have gotten worse since then. So I think these numbers will slide down a little bit more, but clearly there is a hit to global growth. That hit does ease some of the inflationary pressures. It just works on a bit of a lag, but expectations will change because of the slowing growth. Inflation is clearly up higher as a result of the war, and particularly around food and energy. And you can see from this chart, the world is looking at maybe 2.5% higher inflation. We think that some of the core inflation elements that were already easing prior to the invasion are now going to be maybe still working their way down in some cases as people switch from goods to services, but we are going to see really higher headline inflation. Maybe core comes in, but we're going to be facing a more prolonged period. And depending on how long the war goes on and what steps are taken next to disrupt global supplies is going to be a big factor in this. So where we were in a deflationary camp coming in the second half of this year prior to the invasion, we now have moved off of that. There are still some deflationary elements, but near-term inflationary pressures are going to continue to rise. I think another big element for Europe is the refugee crisis. And in the initial stages, I don't see it to be as big a structural problem as is a big humanitarian issue in the near term. But if you go back to the Arab Spring and the immigration crisis that they had stemming from that in Europe, the mindset changed pretty quickly as time went on, because it's one thing to have refugees on a temporary basis. It's another thing to have them become permanent parts of your country and get them integrated and the costs that get associated with that. And then you have new people competing for jobs, and that creates some challenges inside. So I think this is a problem that is in the early stages of developing. And I'm talking about this economically. I always struggle right now with the war to not focus on the humanitarian side of this, because basically 1/10 of the country's population has been forced out of their homes now and maybe out of their country. And that is a tragedy that I don't want to let slip past as we're talking about the economics of this, but it's heartbreaking to see what's going on. And when you look at it from a country basis, these are the countries that are receiving the most refugees, and they wouldn't be viewed as the strongest economic countries in the European Union. And that creates other issues as well on the wealthier countries. And this was a big part of the challenge for the last decade of the European Union, was the rich and the poor nations and who's sharing what costs that get associated with it. So I think this is an area that requires a lot of watching, and it's going to require really good leadership out of European leaders and the rest of the world to help deal with this crisis, because as we see every day, the country is getting torn up and people will not be able to move back to their homes very easily. The other element of this pandemic, and now layered on with the war, is now you have a resource crisis that's growing. This chart shows you the average price changes since January 22nd. And we know the wheat problem and the fertilizer problem. When you get into nickel and palladium and aluminum and iron ore, platinum, zinc, and copper, you're getting into all the new technologies that are at play here. And that actually has big implications for how we solve some of this problem, because if we can't use technology to lower the costs of things going forward at the same rate we'd like to, because we don't have availability of supply, that's going to extend the cycle for inflation. So how you secure these resources as a nation is going to be very important for what your economic future is going to be and what your standing is in the world based on that going forward. I'd also point out a lot of those resources are absolutely essential in the military and weapons and the like. So again, it's a security issue. Europe has a big problem in terms of how they secure their energy needs going forward with their over-reliance on Russia. And I think one of the big outcomes from this invasion is that securing critical natural resources, food, energy, and raw materials that are essential for moving your country forward is going to require stockpiling and reorientation around supply chains around the world. And it's going to align nations around economic and security blocks, in our view, that are going to require a rethink of who you're partnering with. And I think this crisis just shows you how countries have to think differently about this than they have in the past. This also means the clean energy transition, in our view, will take longer and be more costly because it's going to require both fossil fuels and renewables to get there. And all of them are facing some structurally higher prices as we go forward. I think the other element is defense spending is going to be on the rise. We've talked about this the last couple of weeks, but this is an area that if all this spending was up 50%, you'd add $1 trillion roughly to GDP, or redirect $1 trillion of spend. And that is going to have some very highly defined beneficiaries. So what does this mean for investors? And the developed market central banks are going to be forced to live with higher inflation because they can't afford a recession right now, and they can't afford raising rates enough to tip their economies into a recession with all the other problems that exist today. So we believe that certainly in the US, they're going to make the choice of letting inflation run a little hotter to not tip into a recession, because the recessions could be pretty difficult to get out of given the lack of firepower that they have. Fortunately for the US, coming into this year, we had overstimulated the system, which had led to the inflationary forces that we were seeing. And that's part of the reason why we're, as Greg highlighted a few minutes ago, we're only 3% off the all-time highs on the S&P, considering all the problems that exist right now. So that's a big change. So we have a lot of stimulus in the system, which will allow them to live with higher inflation, but a recession would be very difficult to deal with. Clearly, you want to favor equities over bonds in this type of environment, although I did see this morning an interesting report that says from the first time there's an inversion to the time the recessions hit, both bonds and equities perform in a positive way. I thought that was an interesting take because you would expect that bonds have gotten hit hard this year already, but right now they're down about 7.5% through yesterday on the 10-year. I think that there are opportunities to make money here. You just have to be very selective. We think it's very much a domestic US versus global environment, and strong balance sheets over week. This is a quality environment in our view. Rising rates mean we're going to have multiples continuing to contract. We started at the beginning of last year reducing our exposure to the high multiple, big need for growth stocks. I think that's one of the changes that's going on, and you really need to focus on avoiding the valuation extremes and focusing on quality. I do think China's going to be the big issue of how this thing gets resolved, and we have a wide range of outcomes. And I think how China wants to play this because of their relations on a geopolitical basis with Russia and other autocratic nations. But from a commercial side, their best customers are the democratic nations, and that's where most of their trade's done. So how do they thread the needle with their geopolitical views on one hand against their commercial views on the other? And what we saw with sanctions is sanctions will make people choose in some form. And does that lead us to these security and energy blocks or economic blocks that are going to be created around the world that lead us to different strategic alliances? Not sure how that plays out. And it is, I think, one of the harder things we're going to have to deal with going forward is the uncertainty of China is the second largest economy. What role do they want to play here? Lastly, I just touch on the investment side. Our investment themes remain the same. And one of the benefits that we have is as we write our outlooks and we take a forward-looking view of the world, it allows us to get ahead of some of these things. So our defense exposure was already high. We had been building up our exposure to fossil fuels because we saw capital was going to have to flow back to them. We continued to invest in electric vehicles and the like because the energy transition has to happen. But you want to own the things that are going to be essential spends for countries, companies, and households. And I think that shift is going on right now, and it's going to require us to rethink where we're putting capital. Last thing I'll leave you with is earnings and CapEx will drive stock performance. This will not be a period where beneficiaries are equal. In fact, we think this is going to be a significant narrowing, but similar to the late 70s where you could make money if you're in the right areas, but if you were just treating this the way you did the early 70s, you weren't going to make money. We've done this in the past at ARS. We built capital in low growth periods or higher inflation periods. But you can't go into this period that we're entering to right now since February 24th with the mindset I can keep everything the same way I did it before and not make adjustments to it because nothing's changed. In our view, everything's changed, and you really need to rethink your investment strategies. So I'm going to stop there, Mark, and open up for questions.
Thanks, Stephen. Questions, comments?
It's either full agreement or completely against.
I have a question, Stephen. It's Janan George. Good day and amazing work always. I'm good, thanks. Talk about the wheat. I thought that was interesting. U.S. is making major wheat exports to China. I was surprised to see how large the wheat issue is compared to copper, say, or other precious metals.
Yeah, I think what we found with when this war started was how many really essential resources come out of two places, even though the GDP of the combined Russia and Ukraine is only 2% of global GDP. They have a very outsized influence on the global economy in food and energy in particular, but also in some absolutely essential commodities. And you don't realize it until the supply chain starts to get disrupted. And I think that's going to lead to a lot of stockpiling. But, we've always known there are food problems around the world. We've had them existing for some time. What's happening now, though, is that the wheat problem, as it's impacted the Middle East, is not a first occurrence. It's happened several times in the past. And I think that because of the past experiences, we didn't expect a war in Europe to occur in most of our lifetimes again. And I think that's the calculus that has to change in the way you look at investments these days and the investment landscape. So I think that's what we're facing. And unfortunately, the problem with this is it's going to impact those who can afford it least first. It's going to be the people of Ukraine and Russia are going to be suffering for extended periods because of the damage that's been done, and it's going to take a while. That's where the steepest economic price has been paid, but it's also going to be followed by the poorest nations are going to feel this the most, and that's a lot of the people in the Middle East. It's a lot of people in Africa, and it's a lot of people in South America and Southeast Asia are going to be severely impacted. It's also the poorest households everywhere around the world where food and energy is a bigger part of their discretionary spend. And it's going to choke off other spending for a lot of those people. And that's where the hardships are really going to come in. So not really a surprise, but the surprise was the outsized influence of a war in Europe, which we didn't expect to happen.
Thank you.
You're welcome.
Other comments, questions?
Hi, Steve. It's William here. Can I ask a quick question? I appreciate the overview. You obviously were focusing on food and energy, and I'm wondering about government reactions, stimulus packages, a type of like Biden's Build Back Better, which obviously is focused on energy. Do you see that happening in Europe, and do you see it addressing any of the food areas, ag tech areas? Thank you.
Yeah, I think that's a great question. I think the first thing that's happening in Europe right now is they're starting to look at subsidies to deal with the increased energy prices. And they're going to start doing, and they're doing this in states in the US, is they're waiving the tax on gasoline, for example, to try and offset the near term. But that's just kicking the can down the road and creating other problems, but it's what you do in crises. You put crisis intervention in, and that's often good short-term stuff, but bad long-term policy. I think what really has to happen in Europe and in the US, but really everywhere around the world, is you're going to have to, if you're a government leader, think about what is essential for protecting your nation and how do you secure those resources in enough quantity that you'll have them and not be beholden to, as I said, in the case of what's happened over the last 20 years, we've given autocratic leaders control of a lot of the essential resources, and that has to stop. So I think this is really where the intersection of geopolitics and economics really comes to play. And I think that's what we're going to see play out, which is why I believe you'll end up with these blocks that are kind of economic and security blocks of like-minded nations working to be protected, which means globalization will be different than it was. I don't think it's going to end. I think it'll look at, you'll reorient in global supply chains around affiliations and alliances that work for you and for your people. And I think that's why we have to believe everything's changed today. Does that help, William?
Thank you. Yes, that is. I'm most interested in the ag tech space in particular, but I do appreciate that revisualization of globalization. Thank you.
I think there are people on the call, like, I don't know if Eddie's on or others, that are much better on the ag side than I am, but I think from a 30,000 feet, I think that's the way countries are going to look at it. And I think that also is how companies are going to start looking at their supply chains too, which ultimately would mean higher costs. As you're reorienting the supply chains, before you get the system so that you can lower costs, you actually have to have higher costs first, unfortunately.
Thank you.
You're welcome.
Then the asset allocation meeting, I think someone that made a comment that the next war could be over food.
Yep. Yeah, and you know, as I said, Mark, it goes right to the least fortunate feel it the most, and that, you know, it led to the Arab Spring and other uprisings, which is why this creates a whole trickle effect of reactions, actions, and reactions that you have to think things are going to be quite different as we go forward.
Yep.
Stephen, you mentioned, correct me if I'm wrong, but I thought you mentioned that the transition to clean energy will be slowed down as a result of this?
Yeah.
I would think it would be accelerated, but why would it be slowed down? I'm curious.
Well, because you need to heat everything right now. So you have a immediate problem as opposed to a long-term goal. And countries are going to be forced to face with the immediate. And if you can't give people heat by being in renewables, you're going to actually have to stay with the stuff that's worked all along if you can get it. And so I think that I think this is a planning issue that's been a problem when you're back to the start of the transition. Now it's highlighted because we're in the throes of it in the middle of a cold period at a particularly bad time. So I think it's going to have people have to rethink their planning. And also a lot of the green energy requires a lot of the resources that are getting caught up in this that are going to be at higher prices. So if you can't get the rare earths and other commodities that are essential to make the green energy transition, you're going to just have higher costs, and the higher costs will slow down the transition because there's not as big a benefit immediately. And I think that's the issue. It's the immediacy of the problems that leaders have to face. So whenever we get short-term oriented, all plans go out and we do what's most expedient. I think that's why it's going to be that way. In the US, I think we have a bigger issue in that we weren't quite there politically anyway inside the Democratic Party with Manchin. And I think this just really pushes that back a bit. Because we're going to be a big supplier of gas to Europe, which means we're actually going to have to change our mindset around that too.
Right.
So
Thank you.
really complicated and not easy to.
Well,
sort
even in Europe, you know, the nuclear, the way the Germans have moved away, French and others have stayed with it.
Yep.
how that transition takes place.
Yeah.
We have a few more minutes before we're going to transition over to Ukraine and the theater around Ukraine. Not that we're obviously.
Stephen, this is Wanda. So to follow up on this theme of transition and shifting from energy transition to an energy security,
Yep.
how do you see the infrastructure, investment in infrastructure developing? Will it be casualty of long-term or lack of a long-term planning, or we will continue with the infrastructure development?
We're going to spend on infrastructure, and around the world, we're going to have a major spend on infrastructure that's going to have to come. The question is, how do you pay for it? And that's really the political issue that we're going to be facing, because when there is a resolution to the war in Ukraine, we're going to have to rebuild Ukraine as a starting point. Right. So that's going to, and all these things dilute the spend that was going to go to some other of the more pressing issues. I think around the world, we have to look at electrification as a major spend area, but you just can't wish it. You got to actually execute, and I think that's why this whole process will take longer and be more costly. But there's not natural, when you're doing that at the same time as you're reorienting trading and economic blocks and political blocks, you're reorienting a whole system, and that is really what's going to change a lot of things. And I think that's part of the reason why the Saudis and the UAE, when President Biden called to try and get them on board with sanctions and all that, didn't take his call, because they're kind of in between saying, we're in an energy transition too. I need all the customers I can get. So you have a lot of this, it's all colliding. The interdependencies and interconnectedness is all hitting, and it's highlighted when things are bad. It's never highlighted when things are good. So I think this is going to be just it's going to be challenging, and there'll be a number of mistakes made by governments as we go through this process. So
not to mention, I'm saying not to mention that we're trying to address the way that private capital gets rewarded in all these types of investments right now.
Yeah, and the other thing, because the growth is on the come for a lot of the renewables, the multiples on those companies are not that great in many cases as well. So when you have higher interest rates and multiple compression, the investment returns are not going to be as good either. And I think that's one of the big themes for the big takeaways is we're going to enter a period where you're making all these changes that investment returns will not be the same as they've been for the last decade. And I think that's the other mindset change that we have to get squared away.